Welcome back to Weekly. Joining me now to chat about China and his book, Red Flags, Why Xi's China is in Jeopardy, is George Magnus, the author. He's joining me from London. Now, last week on the show, we talked about social issues as it relates to China, ideology of President Xi, and how it impacts their technology sector. Tonight, we're going to talk about economics, finance, debt, and the currency. George, thanks for joining me.
Nice to be with you again, Andrew.
So, President Xi's made it quite clear that he's worried about the leverage in the system and that he wants to deleverage the economy. But as you point out in your book, there are inconsistencies in what he says about doing that, because he suggests that while he wants to take action to deleverage the financial system, he doesn't want to see any diminution in rates of growth, and he also wants to fix the income gap, the disparity between folks in the country, which is tough to do in what you say is going to undoubtedly be a slowing rate of growth, which is part of a deleveraging situation.
Yeah, and I think this is going to be a really tricky challenge to pull off, really, because the way in which the government rhetoric that we hear it nowadays is that the government really, like most governments, I suppose, they want to have their cake and eat it. So they want to deleverage the financial and the economic system, but at the same time they don't really want to let growth rates slip. Now, you can't really do this. I mean, not unless the leverage isn't really a very seriously advanced kind of problem, which it is in China's case. So the issue really is the compatibility of maintaining high growth targets, which China still has, and deleveraging the system. In fact, during the course of 2018, we've actually seen this incompatibility become more and more of an issue. So slowly, the government has been backing away, incrementally, I would say, rather than in any kind of wild U-turn of policy, but they have been backing away from some of the more stringent controls. The bank reserve requirements have been reduced, interest rates have come down, banks are being exhorted to lend more to small companies and export companies. So there will be, I think, a bigger kind of stimulus coming out from Beijing, because they don't want to let those economic growth rates slip too far, too fast.
What's that stimulus look like? Is it infrastructure? Is it tax cuts? What is it?
Well, we've already had some measures or initiatives announced to get local governments to spend more money on infrastructure, which is going to happen, I think, this winter. But I think that the most recent issue, I think, is a statement from the Politburo, which basically says that selective measures will be taken to try to shore up or to support economic growth. I think it's very unlikely that China is going to do anything like that huge credit stimulus that they sanctioned back in 2008. That certainly is something I think they will not willingly embrace. But I think fiscal policy, borrowing more money to spend more on tax cuts and on public spending, that's the kind of thing that I would expect to see coming out this winter.
But just drilling a little deeper on stimulus, because of course here in Canada, we sell a lot of commodities to China. So folks are always hoping for stimulus that drives commodity prices. Do you think we're going to see more of that, like additional measures related to that type of stimulus?
Right, so that's the Pavlovian reaction that I think a lot of commodity companies and commodity countries have when China starts, stepping on the stimulus gas, basically. I think that China can stop its economy from sliding, in a serious way for the time being, but I'm not sure that it's going to gain a lot of traction in terms of boosting growth. So I wouldn't get too excited about this right now. I think wait and see.
So how big a debt problem does China have? Because over here, we read about the high domestic savings rate, and therefore, since foreigners don't own a lot of Chinese debt, if the debt's owned locally and the government controls the system, hey, maybe they don't have that big a problem. But you don't see it that way, do you?
Well, No, Andrew. In fact, I think that is it's a nice myth to propagate, but actually it's just not borne out. I mean, it obviously happens more often to emerging countries that have borrowed extensively abroad, that they get, when things go wrong and foreigners withdraw capital, then they obviously have a major problem. Clearly that's not China's situation. But it's not true to say that countries that have a lot of domestic debt don't get into problems. So the United States in 2008 was a domestic debt problem. Japan in the 1980s was a domestic debt problem. America's savings and loan crisis in the 1980s was a domestic debt problem. And China's debt today is also a domestic debt problem. Just because it's domestic doesn't mean to say that, that it doesn't have an issue. Bad debt is bad debt, whichever way you look at it, and it has to be paid for one way or the other, usually through a protracted period of low growth, even if not a major financial crisis. And I don't think China is going to have a Lehman's moment, because no banks will be allowed to go bust. No serious banks anyway. But that doesn't mean to say they haven't got to address the issues of misallocation of lending and resources, which I think they do have to do. And probably sooner rather than later would be my view.
Thanks very much, George. After the break, I'm going to ask you how the currency plays into the debt equation in China. You're watching Weekly on BNN Bloomberg, and I'm chatting with author George Magnus. Welcome back to Weekly. I'm chatting with author George Magnus about his book on China called Red Flags: Why Xi's China is in Jeopardy. George, before the break, you were explaining why domestic debt issues are as bad as international debt issues, and so China is not out of the woods. How does the currency play a role in whether or not the debt problems in China actually become a big problem, or it's okay?
So the renminbi is really a sort of a weather vane of what's actually going on in the Chinese economy, how the government is managing the debt situation, what sort of influences are coming into China from the trade conflict, and so on. And I think that if China were to lose this veneer of financial stability that it's desperate to maintain, to be honest, then I think the currency would drop quite significantly. It has fallen quite a lot this year by Chinese standards, but no more so than the rise on the other side of the US dollar. But we will be watching the currency very closely, I think, because if it started to drop more significantly than the US dollar was rising, I think that would be an indication that something was going wrong inside China.
But when you talk about how the government wants stability with respect to its exchange rate, in your book, you suggest that domestic money and credit policy, those two variables need to be consistent to potentially have a stable currency, and in the case of China, they're not consistent.
No, and so there is this, we spoke earlier about China having a domestic debt problem, so the issue isn't really all of the foreign money that's waiting to leave China. The issue is all of the Chinese money, the renminbi money, the assets in the financial system that hang over the currency and might be tempted. A lot of this money may actually want to leave China. A lot of people may decide, if the currency starts to misbehave, companies and households may decide, despite capital controls, that they will try to find ways of getting their money out of China. And I think if that happens, that'll exacerbate this problem. So the issue is really about the stock of domestic renminbi liquidity that may not be stable if confidence started to evaporate, which is a possibility for a country in China's situation.
Do we need to worry if the renminbi goes above 7 to the US dollar?
I think if it goes there or starts to move above there and further in a controlled and smooth fashion, and China isn't losing reserves or having to support the currency in a material way, I don't think people, there'll be a lot of noise about, the number 7 being broken, but I think that it's not really a kind of a big issue. The issue really is if the currency is falling at a time when China is having to support it despite that and losing reserves, then we'll know that something more serious is amiss.
So what should we watch for? What are the variables that we should watch for to assess whether that's happening?
Well, we clearly need to watch what actually is happening to the currency and whether the pace of renminbi depreciation is accelerating and what's happening to capital outflows. Because if capital starts to flow out in larger quantities than now, and we've seen more extreme examples of this during 2018, for example, in Turkey and Argentina. I'm not saying it'll be on that kind of a scale, but that would be a worrisome development.
So do you expect to see further restrictions on capital outflows?
Well, the restrictions were tightened quite considerably in 2016, and so I guess that the situation is probably more resilient now than it was then. But people can be, and companies can be quite ingenious in finding ways around these controls.
Now they are continuing to table deals, that is China's continuing to table deals that imply they're trying to widen the use of their currency, yet you point out in your book that they're not really taking the actions they need to if they want their currency to be considered a reserve currency. Do they or don't they?
Yeah, and well, I think, they do express, and the leadership has for some years now, expressed a lot of dissatisfaction and disquiet about an international monetary system that's dominated by the US dollar. I don't think they want, and they certainly would concede they're not prepared yet for a situation in which the renminbi could be a major currency, let's say on the par with the euro. The kind of the myth about China's reserve currency becoming a reserve currency is that people can't really get over this kind of substance problem, which is there are only two ways you can actually have a reserve currency, both of which mean that you have to allow foreigners to acquire your currency very easily. One is to run big balance of payments deficits in perpetuity, and the other is to have an open capital account in which capital moves freely abroad. So China has a more or less balanced balance of payments, and it has quite tight restrictions on capital movement. So people will use the renminbi more in swap agreements and to denominate trade, but I don't think it's at risk of becoming a bigger reserve currency, to be honest. No bigger than sterling or the Swiss franc or the Japanese yen.
Should we expect much out of the G20 meeting with Trump?
We can hope, Andrew, but I'm not holding my breath, really. I mean, the mood music and the atmospherics between President Xi Jinping and President Trump don't seem that great. President Trump has already kind of threatened to increase tariffs again to the rest of Chinese imports, and Chinese don't want to really make concessions at this stage. So I fear that nothing much will come of this G20 meeting.
Okay, so the trade rhetoric is going to continue to heat up over the next 2 to 3 months is what I deduce from your statement. One last question, George. Is China going to have a crash or cause a systemic event over the next 2, 3, 4 years?
I don't think it'll cause a systemic event, because I don't think they'll have a systemic financial crisis, which is the like of which we had in most of the Western world, not in Canada, in 2007, 2008. But I think we should be really alert to the cost that China will have to pay to deal with its debt and other economic problems with a governance system that's not really that conducive to solving them, and that cost is much lower growth.
Thanks very much, George.
Thank you very much.
I've been